Look, have a seat. Thanks very much for coming along. For those who don't know me, my name's Toby Potter. Look, thank you very much for coming along. This is, as you would have heard this morning, private markets is an issue which is becoming increasingly central to the way in which managed accounts are created, advice is created, and client outcomes are achieved. And so we thought it would be interesting to take an opportunity to look in more detail at the opportunities that private markets, private credit, private equity, infrastructure offer to investors. And it's a pleasure for us to have Blake Hesford from MLC Asset Management act as the MC for this afternoon's session. So Blake, thanks very much, and over to you.
Thank you, Toby. So as Toby said, today's session is really an important one, which a lot of you are really grappling with is, should I incorporate private assets into my client portfolios? And if so, how do I do that in an effective way? It's really a challenge. Obviously, this is an IMAP session, managed accounts are front and centre. So we're going to unpack, should that sit inside a managed account? Should it sit outside? What are the different vehicles and what are the different parts of the private assets complex? We're going to have some expert speakers covering off different parts of the private markets landscape. And the idea of today's session is really to give you guys insights and also have a discussion at the back end around the different concerns and challenges you're facing in your practices, and obviously hearing from the experts and their opinions. So we're going to have four presenters. At the end of each presentation, there is going to be a time for a short Q&A, time permitting, if everyone keeps to their allotted time, and then we'll wrap it up with a panel discussion at the back end. So with that, I'll pass over to the first speaker. We've got Kieran Canavan, Chief Investment Officer from Findex Group. Kieran began working in financial services industry.
I'm sure you don't need to do all of
that. A great track record, long career in the industry, and I'll pass over to Kieran to kick us off.
Yeah. Look, thank you so much. I think this is quite a small group, so I'm very happy if there's questions as I go along. I've got a couple of slides up front, which I'm actually going to go through relatively quickly because they just set the context of the way we look as a firm and our team looks at, private type of assets. So please stop me along the way, but the first couple of slides are going to be relatively quick. Obviously, the disclaimer. When we look at our MDA ecosystem, when I'm talking about this, we're really going to be talking about what we do in depth within this ecosystem. So the main parts of the ecosystem, realistically, we're running managed discretionary accounts, not managed accounts. I think that's probably one distinction. So that does allow us a bit more flexibility than in the managed accounts. That said, there's probably a lot of clients within our firm that we could use in a managed account scenario. So if we look at it, we really have an investment committee, which is the governance structure, has a lot of very competent people on it, people with a lot of experience, like Emmanuel Kalageris, Tony Breen, etc. That governance structure we find is incredibly important, and it becomes even more important when we start talking about private assets, because the people that are governing the decisions we make, do they have the experience? Because private assets, there's some things that are really difficult within there, especially the valuation of private assets, because you could take the word of anyone that's selling you a private asset, but at the end of the day, you've got to, and APRA has said this to a lot of the industry funds, you've got to understand how to value those private assets, because a lot of the industry funds have ended up with the same asset from three managers, three different valuations. So if you're going to get into private assets, you've got to understand how to value them. We use asset consultants as well, so we've got a team internally, but we are using people like BCA, JP Morgan, Goldman Sachs, and State Street that provide consulting services to us across various areas, from strategic to tactical asset allocation, but then also underlyings as well. The team that we have, there are a couple of various areas, and probably worth pointing out here, we've got the model investment functions, which are really around SAA and TAA. So we run models within Australia and New Zealand. We run New Zealand in a DIM structure, which is the same as an MDA. What's really important, and when it comes to private assets as well, is this investment reporting and monitoring the performance. That's a lot more difficult to do. And then the research, the selection and monitoring, and I've got some specific slides on, how do you go and choose managers, because it's a different skill set when you get to these managers. There's not as much information as available. Governance oversight is important. We spend a lot of time as well on this part here, which is the advisor. At the end of the day, there has to be a very clear, deep link between what the research team, the governance teams are doing, and how does the advisor work with everything in there? How do they communicate it to their client? What is it going to feel like when they have these assets? And the rest is fairly simple. So when we think about building portfolios, when we're talking about private assets, and really we'll probably, when we talk about ours, talk about alts. We've run an alts program that has got private assets since about 2018. We probably run today in the liquid alts about $1 billion, and then individual managers probably another 700-800 million. When we look at our MDA portfolios, first distinction when I'm talking to you is we have got MDA portfolios, which are for our general clients. There's about $11.5 billion in there. Those general clients are all seen as retail because we manage the MDA on IDPS and super. So for us, a really big part of looking at private assets is how do we get those private assets in an appropriate format into IDPS and then superannuation as well. But we also do look at them, and everything that we do, we consciously are aware that within our firm, there's a lot of clients that are wholesale clients. So, and that can be not-for-profits, can be family offices, it can be endowments, it can be foundations, etc. So when we're looking at the private assets, we're looking at it first and foremost through the MDA structure, but then anything we use there, we want to still have access to those private assets for those wholesale. But it's a lot easier to provide access to the wholesale clients. So when we look at these, really, we look at it from an SAA. So we have a top-down SAA where we're looking at capital market assumptions, looking at the objectives that the advisors need and clients need within those portfolios, set a strategic asset allocation framework. We do that with those consultants, BCA and State Street primarily. Then we start talking about portfolio construction, and I'm going to spend quite a bit of time going through why we think these sorts of assets are so important in portfolios. And I think that sort of became clear earlier on today as well, that these alternative assets, these private market assets, have got a real role to play within portfolios. And you see that in the industry funds, and you see it in institutional, very large institutions running money. So we then have a tactical asset allocation framework. So when we're thinking about these private assets and you're thinking about tactical or dynamic asset allocation, you've really got to think about how do you work with them. Because not a lot of them are necessarily liquid. You may find structures that are designed to give you liquidity, but at the end of the day, if there's a mismatch in liquidity, you don't necessarily want to be rebalancing if you're trading at a big discount to NAV. And you don't want to be a forced buyer when everything's trading at a premium to NAV. So tactical is important, and it's important in then how you construct these and get into these private assets with a tactical overlay if you're going to use a tactical overlay. A lot of work on the manager research, a lot of work's done in there. However, what we do acknowledge is that the alt universe is very complex and it's vast. So we tend to work with partners in that space, and the partner in that space that we deal with is Grosvenor, GCM, Grosvenor Capital Management out of the US. They've been doing this for since 1971, so quite a couple of years. And then we build target portfolios. Now the portfolios, if I look at the portfolios and I look at what we're building for our retail clients, they are similar sort of portfolios. They will run across the efficient frontier from a very conservative portfolio to a high growth portfolio. And because they're on platforms, all the assets need to have retail disclosure and they need to be liquid. And I put inverted commas because that liquidity sometimes will dry up because of price. But when we build portfolios for wholesale clients, we can still use the framework of SAA, TAA, all of those things, but you suddenly get a very different type of portfolio. So we have a family office that we've done portfolios for. If I look at their portfolio, which is probably more towards a growth portfolio, our retail portfolios might have sort of 15 to 20% in alts, theirs would have at least 40% in alts, and their alts would be going in at a very illiquid wholesale structure. And then ongoing management and reporting, I think there, once again, valuations on private assets, it is a skill set that's difficult to come by. So once again, we rely on our partners and third-party validation of that. You know, if you're doing unit pricing on a fund that is a PE fund or something like that, and you're doing monthly unit pricing, how do you actually do the valuations on that? We deal with one hedge fund out of the US, which we're bringing to market now for wholesale investors. Their team is on a separate floor, external value overlays on that. Their teams are bigger than most industry funds teams. Their valuation team is bigger than most industry funds investment teams. So it's something that I think you need to use externals to help with. At a high level, what are we designing the portfolios for? Really for us, for our clients, we're talking about capital security, the ability to compound. So that's quite important. As we talk through these assets, you'll see why these assets work quite well. Real versus nominal returns, obviously in high inflation, that becomes really important. Risk management, liquidity, and risk versus reward. So alternatives is a growing market. You can see the numbers there. 17 trillion is a large number. 1.5 trillion in Australia. And if we look just at private credit, you know, we've seen globally that now is above, and these numbers are probably already outdated because it's growing so quickly. 2 trillion. Private credit has seen growth here in Australia that is absolutely incredible. So I think we're already sitting over the $200 billion mark, and I'm sure some of you know the managers that are in there. But just as a bit of an aside, when you start thinking about, well, if we look at things that are similar, so this is looking at, and sorry, it didn't copy across all that well, but it's BBB structured credit, and it's comparing the spreads here, down the bottom here, for the public markets. And this is the weighted average loan term. And up here, the private markets for exactly the same. So you'll see here, European CLOs, private, have got a spread of 650. European CLOs, public, spread of 325. So very clearly, you can straight away start seeing that being in private markets, you're going to have, you know, a potential to earn a lot more. There comes additional risk with that as well, liquidity risk, etc. So stop me along the way if you've got any questions, because I'm going relatively quickly through this. So just a couple of things. Why do alternatives matter in portfolios? So we're just looking at this, alternative investments on that side and then traditional investments here. And we have a look at what they do through various regimes. And the regimes are recovery, expansion, slowdown, contraction, probably the standard regimes that you all know. And then we're looking at private equity, private debt, real estate, hedge funds, infrastructure, and then we're looking at the S&P, the MSCI World, Russell, High Yield Index, etc. What you'll see, and one of the reasons we really like the alternative investments in the private sectors is you're getting significantly lower drawdowns pretty much through all the regimes that are there. But your upside capture is still pretty high. So just looking at when we're looking at building portfolios, benefits of investing in private markets, these will probably be what you all know anyways, illiquidity premium. So it's getting the premium for something that's illiquid. So you can still get that premium even if you take something and you try and make it liquid. Because your underlyings, you should still get the liquidity premium. Lower volatility than traditional markets, less correlated with public markets, broader investment opportunities, and a large number of companies today, private companies, are staying private for a lot longer. So that investment universe is very different. But when we get to the risks, and these are the risks we see. So I'm not saying that they are necessarily the risks that you would see in your portfolios or what you might be worried about for your clients. Or if you're on the product side, there might be risks that you say, well, I'm actually quite fine with it. People understand it. But when we're building portfolios, these are really important for us. So we see similar risks to the public sector, which is, you know, your currency, country, sector, those sorts of things. Currency in private assets tends to be harder to work with. It's harder to hedge. Key difference to call out, though, is valuation risk. So Strong governance is the key. I spoke a bit about that earlier on. And then the complexity of the underlying assets and the structures. So those asset structures that can be in private credit and those things are a lot more complex. But one of the things that worries us quite a bit is this potential mismatch between the underlying investment and the vehicle that you're accessing it through. So when we've built this for ourselves, we tend to build the vehicles ourselves, and because we know it's just our clients in there. So we've got more control. One of the issues is if you've got a mismatch on liquidity and you've got a very broad section of clients, what tends to happen is you've got very little control on when people start coming out. So what you saw through the GFC with some fund managers, we did say a bit about it this morning, is that they started off with maybe sort of 70, 80% in public markets, very, very liquid, and then sort of 30% in more private markets, very illiquid. As the GFC hit, a large swathe of people started selling. They actually gave liquidity, and that very quickly became 90% private, and then they locked. And some of these funds locked for 8 years. So it's understanding the nature of that. And if you're happy with the nature of it, that's fine. So I think you just need to understand the benefits and drawbacks. And I'm going to come through to what we do in a moment, which is a way that you could sort of think about, could you do it that way? So if we look at these, manager selection is really important. I think this is something that as you start looking, because it's something that's not really done a lot in Australia yet, but as you start looking at accessing private equity, private credit, various alts, infrastructure, etc., is really understanding that selecting the right managers is going to be super critical. If you look at the various differentials there between the top managers and the bottom managers, it is absolutely stark. If you end up with a bottom set of managers down there, that is a substantial downside to you and your portfolios. It negates any reason for going into these types of assets. Preservation of capital in down markets. Once again, here we're looking, actually, this was just a bit of work that we did on hedge funds in our own particular alts. So in down markets, obviously, you've got a lot less downside capture. You're still getting around about 50% market upside capture. So just important, once again, if you think about the portfolio construction and you're blending public market assets and you're blending private market assets, is the downside capture is a lot less. You're going to have less volatility in those portfolios, but you're still going to have reasonable growth. Once again, tailwind for alternatives in particular, but it'll go in private equity and that as well, is if we have a look at the annualized returns on the left-hand side for hedge funds and equities, and then you look at the Sharpe ratio of those, there's a real benefit in having those sorts of things from a portfolio construction point of view. So your absolute returns and relative performance to equities under different interest rate regimes is actually really, really positive. So I'm going to run through a bit of our journey now and what we have done. So for us, the very first thing I'll say is we use Grosvenor. I think you heard the guys from Evidentia this morning. They're using, I think, iPartners. You need a really good partner. My view is, sorry? iCapital, sorry. Thank you. I knew that. At least I got the I right. I think from that perspective, you need a partner in there that can really deal with the complexity of these sorts of assets. For us, when we built them, we wanted to build exposure within alts on a growth exposure and on a defensive exposure. And what we ended up using Grosvenor for the growth, and we used Wellington for the defensive. So for us, when we build something like this, the concept, as I said to you, is we have retail clients that are in an MDA that are on platform. So we need to get whatever product we don't get using, have to get that into Super and IDPS. But what we're trying to do when we build these, we will build a strategy and we will wrap the PDS ourselves. So we acquired an RE so that we could wrap ourselves. We will build the PDS. We will build enough liquidity into those PDSs, either via the underlyings or using, as we do with Grosvenor, a line of credit from RBC, that we know we can keep it liquid and we can manage what the super funds need to do, because they need to be able to pay out on death benefits. So they've got a period of time they've got to pay out the death benefits. So not everyone's going to die at the same time, so you've got to convince them that there's enough money for them to pay out, and that the fund can pay out, and then also if there's hardship. And we saw that probably the best example was 2020 through COVID, where people could draw into their superannuation. So both of those don't mean that you have to sell the fund down to zero. So all the discussions, and we've got this on multiple platforms, with the trustees is always giving them enough confidence that there's enough liquidity there for our set of clients. It's easier for us to do because it's a captive set of clients and we're building those portfolios. The other thing, when we build these vehicles, the underlying vehicles will typically be either a Cayman's vehicle, or it'll be an Australian unitised trust that goes into a Cayman's or a UCITS vehicle. So for us, when we build these, although we want the front-facing vehicle to be retail so we can use it in MDA, those underlying vehicles can all be then accessed via wholesale investors. So we run within fixed income, we use private credit, we run with Insights, we run with Schenkman. Schenkman's a very big US manager. We seeded them with a very large super fund, industry super fund here. They created a wholesale trust. We just pushed that wholesale trust into a retail trust. How are we going on time? We don't have one of those little time things there. 5 minutes. Yeah, okay. So just running really through, once again, and these slides will be available to you, so you can have a look at it. This is just drawdowns. If you have a look at alts and how they play out, this is just a summary of the previous one. So you can see huge performance of growth. These are growth alts when the MSCI ACWI was down. And the relative performance is staggering. So 24 months, 22 of those months, that was the outperformance in bringing that into a portfolio relative to having the MSCI ACWI. I might just pop past that. I'm going to talk now just a little bit about some of the strategies that we use in private credit. So once again, that's what I'm saying, it's so important to actually understand, if you're going to go into these, what are your underlyings? And what is the risk in those underlyings? So for us, when we looked at private credit, we actually feel pretty comfortable with private credit in warehousing. Why? Because warehousing, you've got a lot of assets in there. They're much more liquid assets. So it's highly diversified. The valuation risk is less, etc. So for us, when we went into private credit, that's the area we wanted to play in.
When you say warehousing, Kieran, do you mean physical warehousing or do you mean financial?
Sorry, financial warehousing. So private credit. So private warehousing as in warehousing of mortgages, debt, etc. So that was just a place that we really wanted to play. We, from that perspective, actually deal with Realm, their strategic income fund, which has that. So we don't necessarily always go for an underlying that we have to wrap. We'll use what's in the market as well if we think it's appropriate. Maybe just talking a little bit about our wholesale client offerings. So there's a concept when you're looking at PE and other things and infrastructure that a lot of the institutions and the ultra-high net wealth clients and the family offices look at, and that is the co-invest. So when you think about co-invest, if you're going into a PE firm, you might be paying 2 and 20. But if you've got really big investors and they're putting 50 million into a PE firm, what they will expect is another 50 million or whatever it happens to be. It might be 25, it might be 75. That's co-invest. That co-invest doesn't have the general partner, the GP, the hedge fund, or the private equity fund, whatever it is, it doesn't have their fees on it. So it doesn't have the 2 and 20. So when you think about it, if you're putting 50 million into a GP at 2 and 20 and you're putting another 50 in the co-invests they give you, your fee's not 2 and 20. It's 1, because you have no fees at all on the co-invest, and then your performance fee, depending on how and when it's charged, because that's another thing to watch out for when you're getting into private equity. If you end up paying performance fees and it's not on realization of an asset, those performance fees, especially if they compound over a period of time, can be exceptionally high. So the way we're looking at that now and what we're bringing out to our wholesale clients is a co-invest platform. So a co-invest platform, because if you think about it, it's very difficult to manage co-invest unless you're a very big player. So for smaller players, what we wanted to do is have a co-invest platform that allows clients to get into various verticals. So we'll actually run 5 verticals: private equity, private credit, infrastructure, absolute return, and then opportunistic. And to give you a sense of what that looks like from the investor's point of view, they will go, so there's no GP on here, there's no fees in there. They'll get 20 to 30 co-investments. That's the structure in PE, private credit, infrastructure. So I think as you're thinking about these things, and I see some of the people that I know here that work in this, like Sam that's here as well, people are thinking about that. So what you need to look at is how do you also potentially get access to the co-invests, because that substantially changes the metrics when it comes to fees, outcomes, etc. But you need a professional manager managing it. I don't think as an IFA or an advisor, you want to be sitting trying to manage a whole lot of investments. So I think we had time. Yeah. There's a couple of things there. You can. I'm good. These just some of the co-invest examples that we have, and co-invest Grosvenor runs ours for us. So thank you very much, guys. Happy to take any questions if there's anything now or afterwards.
Yeah, if there's any immediate questions for Kieran.
Kevin, I've got a question which is, presenting in a group like this amongst people who are broadly knowledgeable is one thing. Talking to clients where they're making money by selling petrol or tobacco.
Sorry, you need the microphone for recording.
How do clients respond to these types of issues, or this sort of presentation?
Well, first of all, I think this sort of presentation is not a presentation that we'll be doing to a client. When you look at the retail clients, it's really up to the advisor to articulate what's happening in the portfolio construction. And we as a team have to make sure that we give the advisor the right material, the right communication material, access to people like Grosvenor and things like that, so they can understand that and then they can work with their client, because that's part of an advisor's role, is education with their client. However, when you come to the ultra-high net wealths, the endowments, all of those sorts of things, very different. This sort of presentation resonates, especially if you can have a look at what they've got and then put it in context of what they have. That's the key. It's no use doing this on its own and not looking at the way they're looking at the world. So I think that's perception is super important. That you've got to look at through their eyes, and then you do this sort of presentation with them. And then I think it works very well.
Thanks. Kieran, you spoke about the additional flexibility of MDAs over SMAs. So can you give us an example, a practical example from your perspective of things that you do within your MDA that you wouldn't be able to do in an SMA?
Yeah, so I think if you look at a managed discretionary account, what we're talking about, there's a much better ability to customize for clients. That has to be done with the advisor and then also with the investment team. So what I'm getting at there, we will see client preferences, also what they hold when they come into the firm. There's an ability to deal with those. When it comes to these private sort of assets, there will also be clients that potentially don't like what we're doing in that. You can customize, you can take that out. You could go from what we have, which is a unlisted version using Grosvenor within a fund-to-fund structure. You might decide as a client or an advisor, actually, I don't want that. I can then substitute in listed versions of that. And that's absolutely appropriate. So it gives that ability for the advisor to say, well, I want to do something different, or the client, I want to do something slightly different. When it comes to the underlyings we're talking about, it's not making a difference because we're not using that. I think in the SMA world, that personalization, though, is just much more difficult today. Thank you so much. Thanks, everyone. Thank you.
Join me in thanking Kieran, and Kieran will be joining us for the panel discussion at the back end of the session. Next up, we have Russell Pillemer, Chief Executive Officer at Pengana. Russell co-founded Pengana in 2003 and also has a Centric connection, was previously chairman at Centric Wealth and a principal at Turnbull Pillemer Capital.
Okay. Okay, great. Hi, everyone. Thanks for being here today and taking the time to listen to me. So, there we go. So I'm here today to talk about investing in global private markets, being private equity and private credit. So the things that we want to get through, and I think I've got 25 minutes. Okay. So having a bit of a recap on private equity, global private equity, having a recap on global private credit. Why are these asset classes so beneficial in portfolios? Then talk about how you actually implement them in your portfolio, and then pose some questions for you to consider when evaluating these asset classes. So let's start with global PE. So what's in the bucket? Now, I think this is a confusing topic for a lot of people, and when you read the press, they're all over the place about this. So at the small end of the market, private equity can be, seed capital, angel capital, small bits of investment in a very risky startup. At the higher end of the market, it can be investments into large cap or mega cap growth equity type businesses, like if you put your money into something like a SpaceX. All right. And in the middle of this all is buyouts. Which are generally sort of mid-market buyouts, which is our sweet spot, which we think is the best part of the market. So a mid-market buyout, companies that might be valued at, say, $500 million to a couple of $1 billion, and they're doing management buyouts, leverage buyouts, so they use leverage in their acquisitions. And we like this because the mere fact that you use leverage means that your business has to be a nice, stable business. So we think this is a sweet spot in the market. We think this is where the best risk-return trade-offs exist. It can be a significant enhancement to your portfolio. So I think the statistics or the evidence will show that over long periods of time, private equity, at least this mid-market private equity, significantly outperforms listed equities, and it does so with low volatility. Now, we can have a chat later on about whether that's real volatility or just pseudo volatility, because things aren't being valued, on a day-to-day basis. But I think for all intents and purposes, it has lower volatility. But then finally, to consider, there are a lot of barriers to entry, and it's hard to actually implement these strategies into your portfolio, certainly for regular type of investors. So, not institutional investors or family offices or very wealthy investors, but, the ordinary type of investors that probably most of us in this room have. We'll talk a little bit about that later on. So manager selection, I heard Kieran mention this topic as well. Manager selection is absolutely key when it comes to private equity. If you were investing in listed equity managers, the difference between the top quartile and the bottom quartile managers are maybe a couple of percent. When you do it in private equity, you can see this over 20 years. The top quartile outperforms the bottom quartile by 15+%. So you really got to get this right, and it's very difficult to get this right because do you have the ability to identify who these managers are, and B, even if you do identify them, are they willing to accept your check? And we'll touch on that a little bit later as well. So why does global PE outperform? So the first thing is there is an illiquidity premium. So the mere fact that you're investing in something that is illiquid means that it should actually outperform, right? Because otherwise, why would you do it? So there should be an illiquidity premium, and indeed there is. Secondly, investing through really good or great PE firms does enhance the value equation. So I showed you before on that previous slide how the top quartile really outperforms the bottom quartile. Well, if you can get into those top quartile managers, they invariably add a lot of value to their investments. And that's why you can see this extra performance combined with the leverage in businesses means that you can really create a lot of value. Thirdly, there are these overt listing costs. Now, I'm talking about global. I'm not talking about Australian private equity, which I think has its own dynamics, which are quite different to global. But in the US market, it is extraordinarily expensive to be listed. You know, the compliance costs, the legal costs, the board costs, the insurance costs, et cetera, et cetera. So when you're operating in a private context, you obviously don't have to have all those costs. And then there's the hidden costs of investing in listed equities. So these hidden costs are really driven by the fact that in the listed markets, you need to do things like have quarterly reporting. Can you imagine running a business based upon your next quarter? So you're forced to do things in your business that really don't make sense in terms of creating value. So I think that is a real impediment to listed business, whereas if you're in a private context, you don't have to worry about that. Next thing is that these private equity businesses, certainly in the US, attract the best talents. You know, why would I go be a CEO of a public company which has got all these rules and regulations and problems, and probably my compensation is out there in the public when I can go private and get much better returns with less publicity, etc. So but it attracts the talents, and by attracting the talent, it creates additional value. And then finally, there's a real supply-demand imbalance in these offshore markets. I think most of you have probably seen these sorts of slides before that shows how these public markets are shrinking. You know, there's less than half the number of companies listed in the US today as there were 20 years ago. So what you find is that all the activity, the private markets are the flip side of this equation, obviously. And so there's a lot of demand for capital in private markets, which are growing at a rapid rate. And there really is, as I said, the supply-demand imbalance, and that provides additional value creation for investors. So let's move on to private credit and the recap of that. So what's in the private credit bucket? Now, there are a lot of activities that are in private credit. And once again, this sort of, is confusing for investors. Investors in Australia, if you say private credit, they think you're talking about property lending. In the offshore markets, that's not the case at all. Property lending is a very small part of the market. Corporate lending is really the key to the market. Almost the whole market is corporate lending. When we think about this, once again, we like the mid-market. So those companies worth maybe $500 million to a couple of $1 billion. And that's a really sweet spot in the market, and I'll explain why that's the case. So what's in the bucket? Direct lending, structured credit, specialty finance, credit opportunities, which might include things such as distressed debt, etc. What's important about this market is that it's a bilateral market, so it's a lender and a borrower, right? This isn't going through intermediaries, etc. This is a one-on-one lend. It's exactly the same as banks would do when they're lending to a borrower. It's secured, so it's secured, if it's corporate lending, secured over the cash flows of the business, over the property, over the hard assets in the business, etc. So it's secured, and it's highly protected. It's protected by the nature of the contracts between the lender and the borrower. So that's when we think about what's in the bucket. The opportunity set is definitely a global opportunity set. Mostly it's North America, and then Europe also has quite a big market. The rest of the world is very, very small. That's why I say we don't, when we look at this, we don't go near the Australian marketplace just because it's a small part of the market and it's property, and that's quite sort of specialised, and that's not what we do. It's about a $2 trillion market, and as I said, there's a lot of diversification of strategies in this market. So the real critical thing about why this is such a good place to invest is that since the GFC, the regulators have put pressure on the banks to stop lending to corporates. They don't like the fact that the banks will have a mismatch between lending to corporates for long term, but on the other side of their balance sheet, they have depositors who can pull their money out every day. We saw these examples of how dangerous this can be with SVB, a couple of years ago. I guess a year and a half ago. So the regulators have put pressure on the banks to pull back from corporate lending, and so there has been a real absence of capital in the market, and into this void have stepped the private credit providers. So there's a supply-demand imbalance, and this has resulted in the private credit providers being able to provide credit at much higher spreads than you would otherwise expect, and much higher spreads that is other than should be commensurate with the type of risk that you're providing. So, or the risk that you're taking. So a private lender in the US markets can lend to a safe and secure billion-dollar company with, say, a 35% LVR. So this is all kind of bank stuff, what a bank would do in Australia. And they can do this at a spread of 550 to even 600 basis points over the prime rate. If it was a bank who was doing that, maybe it's a couple of hundred points at best. So there's a massive spread differential. And you can imagine the risk associated with lending to a safe and secure company at a relatively modest LVR with $1 billion type valuation is really good because $1 billion companies don't fall over. So the experience in these private credit markets has been absolutely fantastic. In fact, if you look at the better managers, the loss rates are close to zero, certainly less than 50 basis points. Maybe they're like 20 basis points. So, fantastic high single digit, sometimes even double digit returns with really low loss rates. It's a fantastic asset class. Let's talk about implementation. So there are challenges. So I've told you all the good stuff. This is a fantastic place to invest. Private equity, private credit, double-digit returns or high single-digit returns, low volatility. Why isn't everybody getting into this? Why don't all your clients have this in their portfolio? Well, it's quite difficult. So the first thing that's difficult is manager selection. How do you find those best managers in the marketplace? I showed you that, the first quartile versus bottom quartile. You don't want to be with the bottom quartile. It's not a great investment. If you can be with the top quartile, that's fantastic. But how do you know who they are? These aren't public markets. The information is scant. You have to find somebody or somebody to invest with that can identify and due diligence these managers. So that's the first thing. The second thing is that even if you identify these managers, you might not be able to get them to take your money because the best managers have lots of people queuing up to give them money. So that's an issue. Third issue is capital efficiency. Now, this is something that I think is a bit misleading and really hurts investors over time. So you'll often see that with private equity funds or private equity investments, there's an IRR quoted. But the IRR is quoted on the money that you've actually given the manager or the fund, etc. But they do this on a capital call basis. So they'll say to you, you want to invest $1 million with us? Fantastic. Give us $100,000, keep the other $900,000 in the bank, and we'll call it over time. Now, when they report their IRRs, they're reporting it on the $100,000 and growing 200, 300 until they've pulled the full $1 million out, and then they have it for a period of time, etc. That looks fantastic. But you as the investor have kept $900,000 in the bank earning 4% or whatever you can get in the bank. And they can call this from you usually with 7 days notice. So your IRR on your total $1 million is not that great, even though the managers are reporting a fantastic IRR. So this is something really to watch out for. And we have the saying in this end of the industry that you can't eat an IRR, and that's absolutely the case. So other issues with capital efficiency is FX risk. So with global private equity, private credit, you're in these global markets, you're US or Euro denominated. A lot of investors don't want to take that FX risk. So unless you actually are able to invest in vehicles that handle the currency themselves, you've got that currency mismatch. Another thing with capital efficiency is once you get invested with these funds or these managers and you've got your full $1 million with them, the last thing in the world you want is for them to give you the money back, because they give you the money back, you've then got to get reinvested. So you actually want them to keep it for as long as possible, or you want to be in a vehicle that's a more evergreen type vehicle that just continues to invest. So you never get the money actually returned to you and have to actually find a way to reinvest it. You want the manager to do that in the vehicle. Diversification is absolutely key. I said that these asset classes are fantastic. If you can get the top quartile managers, you'll do really well. You do not have to pick the single best manager. Go for diversification. You'll cover yourself really well with diversification. Everybody can have accidents, even the best managers. Diversify. And finally, flexibility. This has always been a problem with private equity and private credit to some extent as well, is that you need to lock up your capital with a lot of structures. If you lock up your capital, something else comes along, or you've got a reason why you need to access this capital, that won't be available. Or it's only available with a massive discount. So that's another issue to watch out for. So solutions. Fortunately, there are now solutions in the marketplace, and I think good solutions, not just the Pengana solutions, although those definitely form part of it. You now, as a regular investor, can invest in the types of things that only the big end of town could invest in previously. So the solutions, with each of these solutions, it's critical that they're structured specifically for the type of investor that wants them. So some investors can cope with longer lockups. Some investors need daily liquidity. There's absolutely an inverse correlation between return and longevity of the investment, or lack of liquidity in investment. So you need to have a trade-off there, and it's important that the vehicle that you construct is done with that in mind, etc. So some of the ways to invest, there are listed vehicles. Listed vehicles are great because you've got 100% liquidity on a day-to-day basis. We've also, in our business, and I think some others have as well, although not in the global private equity side, have created SMA solutions, and those are quite different and specific solutions. And then there's also retail unit trust products there, which usually have like a quarterly redemption mechanism, or what they call in the US an interval fund structure, where you can pull out your money on a quarterly basis subject to some potential gates if there's too much redemption. So that's some of the solutions that are out there. The publicly listed vehicles are really interesting. I think this is the ultimate way to invest in private equity and private credit. And why do I say that? Well, from an investment perspective, if the investment manager does not need to worry about liquidity, then they can invest the money in the best way possible. The moment you need to worry about liquidity, you're forced to make some compromises about how you invest. So if you're in a listed vehicle, there's no access for investors to actually get a redemption, so you can invest in the ultimate way possible. There's no liquidity mismatch because of that. You don't need to invest. You won't have capital calls. You can go straight into the vehicle. You can remain invested perpetually, so nobody's giving you your money back. You can rebalance or etc. straight away. And then also what we found with some investors, they complement a listed exposure with an unlisted exposure because they're quite sort of different. The unlisted exposures, there's quarterly redemption with a potential gate, and the listed exposure is daily liquid but can potentially trade at a discount. So they match those two up to create a more diversified portfolio. So the critical thing with listed vehicles is eliminating the discount to NAV. So we all know this issue. You can see it across the market now. The market now is becoming a lot more sophisticated when it comes to listed vehicles and dealing with discounts to NAV. I think at Pengana, we like to take some of the credit for this. A year ago, we launched a listed private credit vehicle, PCX, and in that we put a mechanism that is built to ensure that the product trades at or above the NAV, and that's worked quite well. And basically, what that product does is what the mechanism does is it includes a quarterly redemption mechanism within a listed vehicle. So as an investor, I can get out one of two ways. I can sell my stock on market, or alternatively, I can put it in a quarterly redemption notice. And what lands up happening is that investors don't want to sell at less than the NAV on market, because otherwise they would put in a redemption notice. So you find that its trades always at or above the NAV. So I think, and some of our competitors have now launched vehicles and are using that structure as well. So I think that's a good development for the market, and I think you'll see more of these things happening. We actually have our listed private equity vehicle, PE1, which currently trades at a big discount, and we actually announced that recently to the market that we're putting in some sort of mechanism. We haven't explained what the mechanism is, but some sort of mechanism that will also, take into account the closure of the gap. And I think it's really important that vehicles do this going forward. So using private market strategies in your portfolios, I think this is the most fascinating topic in private markets. So usually people talk about it in the alternatives bucket. But I think that there's so much better applications than that, and that is to use your private equity in your equities bucket and your private credit in your credit bucket. So why would you use it in your equities bucket? Well, as I said, you get higher returns with lower volatility. That's really good for portfolios. Depends how you're managing your portfolio. If you're trying to hug the index, obviously you can diverge a lot at short periods of time. But if you're trying to reduce risk, increase returns, and you're happy to vary from the index from time to time, it's a slam dunk opportunity in your private equity portfolio. Your private credit portfolio, your fixed income portfolio, you can use your private credit there. Think about this private credit. You can be earning high single, low double digit returns in your private credit portfolio compared to what you can earn in bonds, other fixed income instruments. This is actually, I would say free money, but it's close to free money as you can get. I'll tell you a little bit of a secret about the super funds at the moment. All of the super funds are trying to figure out how they can use more and more private credit in their fixed income portfolios. The super funds have these tests that the government's given them, that they have to beat the index or match the index or the benchmark within these various buckets. This is free money for them because they can put into this, it lowers the risk, it hires a return in the portfolio, and they can smash that fixed income benchmark. So this is really, really interesting stuff when you think about these asset classes. Once again, if you want to use these in your private equity or private credit, or in your equities or fixed income portfolios, I'd suggest you want a lot of diversification because you don't want to take individual risks in this. So some critical questions. The first one is, obviously, do you have enough of this stuff in your portfolio, private credit and private equity? If you do the maths on it and you do an efficient frontier and it was unconstrained, your efficient frontier would tell you put 100% of your money into this. Now, I'm not saying that you should do this, but I think in thinking about building your portfolios, people should actually consider the raw maths of it all and figure out, really what might be the best thing, especially for investors who are willing to take those types of, dynamics in their portfolio. So, secondly, have you got enough of the good stuff, right? So I think there's a lot of stuff out in the market. There's a lot of, as I said, we think about the good stuff as, mid-market, global private equity, global private credit, and there's lots of other good asset classes in these categories, right? And good managers, etc. And then there's a lot of stuff which actually isn't so good. So, hopefully I'm not offending anybody in the room, but like the traded credit markets, which sometimes they're products which pass themselves off as private credit, but they're really just liquid traded credit with volatility, etc. So look hard at the underlying structures in your portfolio. Not everything private equity, not everything private credit is actually good. Do you have significant diversification? I've mentioned this a whole bunch of times. You want diversification across managers, across sectors, across geographies, across vintages. Diversify, diversify, diversify. If you get enough diversification and you're able to do this top quartile investing, it's a fantastic low-risk asset class. Capital call structures, as I said, some investors, it can work for them. Most regular type investors really hate this and they can't deal with it. I spoke about that, you've got to keep $90 in the bank while the manager calls it down. If you're a super fund, that's actually fine because there's a lot of money coming in and out and you're investing, etc. For regular investors, it's usually not fine. We spoke about whether your fund has a liquidity mismatch. There are structures out there that have very large, blatant liquidity mismatches. Doesn't mean that they're bad products, but I think that we should really consider that in the context of the underlying portfolio. And finally, how does the illiquidity or liquidity of the various ways of investing, how does that fit into your portfolio? So some investors we found are happy to take some illiquid assets in their portfolios because 70% of their portfolio might be in listed equities or bonds, etc. So with 30% you can take the illiquidity. Some investors don't want it at all. And so there's various ways and means of investing according to the preferences or the outcomes that investors are trying to achieve. So those are some of the critical questions. So just finishing off, my key takeaways from this. In our view, global mid-market investing in private equity and private credit is an unbeatable asset class. Build diversification into the portfolios. Get invested and stay invested. Don't be in and out of this asset class. And then finally, think about allocating to your equity and fixed income pieces of your portfolio, and not just your alternatives buckets. I think good for timing. I'll stop then. Fantastic.
Stay up there, Russell. Any immediate questions for Russell on presentation before we pass it over? Just a quick question from me. You spoke about the growth in private credit and the really attractive spreads. Have we seen any compression on those spreads, and do we expect those to be that attractive moving forward?
Yes. So in global markets, global mid-market private credit, there has not been any compression, and I think there's still a supply-demand imbalance, and I think that's actually not getting any better over the next 5 or 10 years. So I don't think for the foreseeable future, we don't think there will be a compression.
And Russell will be joining us for the panel session at the back end of this. Next, I'll pass over to
Thank you, everyone.
Thank you, Russell. Next, I'll pass over to David Chan from MLC Private Equity. David joined the business in 2009 as head of Asia and has extensive industry experience spanning over 20 years. David actually started out his career as a software engineer and worked for Sun Microsystems, among others, Yahoo, I believe, as well. So quite a diverse skill set. But I'll pass over now to David to talk around private equity.
Great. Thank you, everyone, and good afternoon. Thank you, Russell, for that great overview onto private credit and private equity markets. I'll just take the next kind of 20 minutes to do a little bit more of a deep dive into the private equity markets. What's driven some of those changes you've seen as to companies staying private for longer? Deep dive into the mid-market. As Russell mentioned, we also see it as the most attractive space in that private equity spectrum. And then finally touch upon how you can use that in a portfolio. So the first kind of mega trend I'd like to discuss is why public markets are shrinking and why companies are staying private longer. You hear this a lot in the press. I don't think a lot of detail goes into kind of what's really driving this and what's changed about the markets that allow these companies to stay private for longer. I think regulatory setting is probably one of the first things I'll point out. The compliance costs of staying listed have increased over time. Having kind of the quarterly reporting, compliance with all the different kind of regulations that keep popping up and changing regulations, it's become very onerous on companies. And founders and businesses really want to just focus on their core competencies, all right, which is either selling a product or designing a process or service that solves a solution for customers. Being private really allows you to kind of streamline your process and focus on what's a real core competency of your business. The second one is the rise of private capital. And so while kind of we mentioned private equity is kind of this kind of motherhood statement or word which encompasses a lot of real kind of different underlying asset classes. It includes venture capital, it includes kind of mid-market, it includes large buyout. Beyond that, there's a second layer, and probably the most significant of that is really the rise of the secondary market. And so the secondary market is where investors trade LP positions or limited partner positions, where you enter in a private equity fund to another investor. And what that's really allowed over time is that if you think back in the day when a founder starts a company, they get individual staff to join the company on the promise that I'll give you some shares, and then one day these shares will be worth a lot, and we'll all go IPO and we'll be happy days and you can get liquidity. Quite often 10 years later or a decade and a half later, the company's started to become very successful. The company's not listed yet, right? And then all the employees, and now there's probably like 1,000 or 10,000 employees in this company, all like, hey, we've got mortgage to pay, we've got kids in private schools, we've been on this under market salary for 15 years now, and you must go IPO because we need liquidity and there's no market otherwise for our locked up shares. But with the rise of the secondary market, which has been over $100 billion for the last 4 years, reached over $150 billion last year, you have this active market where any employee, whether you're a SpaceX or Canva, you can just go sell your employee shares in the secondary market anytime to gain liquidity. And so there's not that kind of necessity that you must go IPO when you reach a certain size. In addition, the scale of the private markets have just continued to grow. And so you see it with some of the latest AI funding rounds where they're kind of raising 100 billion at a time. There isn't this cap that says, if I need to raise X amount of capital, I must go to the private markets, because now the private markets have really become deep enough that you don't have to go to the public markets anymore. The third point here, mergers and acquisitions, and really the rise of take privates. You'll see the charts, kind of the US coming down and most of the developed markets. Australia's a little bit of an anomaly in that it's been rising for a very long time and started to come down in more recent years. I think Australia's a little bit different in that we've had the superannuation system really supporting the local market for a long time. That's really been focused on the listed markets. And there's been, as you'll see in some later slides, very little allocation to private markets. As that allocation has started to shift, you start to see that trend reversing and being more in line with global trends, where the US is probably the most ahead of that curve, where you see a lot of companies being taken private off the public markets. It really increases kind of alignment with founders and management team, because in the private setting, they're able to execute their long-term business plans without that quarterly financial reporting scrutiny, but also align the economics to really encourage them to be an owner of that business rather than just an employee. And finally, that strategic preference to stay private. On his chart, you can see a couple of those reasons why private companies have become more and more options, and you can see by this increasing size of the companies and the tenure of companies being really private more than a decade now before they often consider going public. Whereas in the past, it was a much quicker kind of route to become a public company. But what you ended up with many markets, particularly in emerging markets, but you see that a bit in Australia and the US as well, we got these kind of large rump of what we call illiquid public companies, mid-market public companies, where they're a bit too subscale, they don't really have a lot of free float, there's not really research coverage, and so while they've gone public, in all effects and purposes, they really should have stayed private, because it doesn't really afford them much of the typical benefits of going public in terms of increased brand awareness, increased sources of capital, etc. They're still relatively infrequently traded, even as public companies. Strategic preference to protect intellectual capital is an interesting one. So as my role at MLC, and I've been at MLC kind of over 16 years now, and we've actually seen quite a few business models, which when we've seen them as private companies, we're like, wow, that's an amazing company. How do you keep these margins for so long? And they're like, can we actually ever exit this company to the IPO markets? And they're like, no, please, never. The reason is because if our customers ever saw our margins, right, or our competitors ever saw our margins, you would suddenly get all this increased competition in that type of business. And being private and being a little bit secretive, having a business model where it's not clear to the customer how much margin they're making, it's not clear that they don't have many competitors producing this type of product, gives them a very unique advantage. And you can build up quite sizable kind of family businesses. And they're the businesses which we love finding and investing in. The second one is that new form of access of capital. So I guess everyone's seen in the last few years, as Russell mentioned, that private credit market has really grown. I think you start to see that even within the private equity market, there's been the rise within the secondary market of what we call continuation vehicles or GP-led vehicles. These are when kind of fund managers who have a bunch of assets reaching the end of their fund life, instead of selling them to a strategic or IPOing them, they're forming new vehicles and effectively selling them into new vehicles that they create with new investors coming in to price that round. And that's allowed those companies to really stay private for a very long period of time. And it's akin somewhat to an evergreen vehicle. So instead of having a 10-year closed-end vehicle, which is the typical private equity structure, by using continuation vehicles, you can kind of extend the vehicles multiple rounds and almost hold these assets indefinitely. Focusing on long-term outcomes, as well as greater control and flexibility of the business decisions as they grow. I think it's interesting when we look at private markets as well, and particularly PE, is to see what kind of the top investors globally are doing. And so if you look at this chart, you can see Yale, Harvard are nearly around 40% private equity allocation. A lot of the sovereign funds globally, but noticeably even Australia's Future Fund has 15% allocated to private equity, whereas most of the superannuation funds, MLC included, typically have around a 5 or 6% allocation to private equity. And so if it's such an attractive asset class, and you've seen those charts before where it has the highest expected return and relatively modest volatility compared to public markets, why don't we follow kind of global standards and have more in private equity? While I think there's definitely the case that all investors should be in the asset class, and it adds a lot in terms of a portfolio context and improving that efficient frontier, I think liquidity is really something that everyone needs to be mindful of. While there are a lot of structures, evergreen structures, monthly liquidity, redemption structures that you can use today that help alleviate some of the liquidity issues that you see in private equity, ultimately having a larger percent of your portfolio in Australia is increasingly difficult for two reasons. One is our, I would say, incessant focus on fees relative to most other international markets. Australia, we really, thanks to the government and the regulatory environment, really are more focused on managing costs to serve than on pure net returns. And so a lot of the other sophisticated institutional investors globally only care about one thing, right? Which is, what is my net return? They're happy to pay the top firms globally 30% carry, right? Ratcheting performance fee structures if they can deliver certain return hurdles, which intuitively makes sense but doesn't really work in the Australian regulatory environment. The second one is really on liquidity. I think in the past we've seen situations where funds have kind of gated or closed, even when they have redemption windows or quarterly redemption windows. And so that's caused some regulatory pushback on how much you can allocate these asset classes, because we know that most private assets, if you need to sell them quickly, you'll have to sell them at 10, 20% discounts. And so they're really assets you need to hold to maturity. These assets, I think you will see this trend going up over time, but I think in Australia it will be probably a little bit more diversified than globally in terms of the type of alternate asset classes. You've seen a lot of infrastructure in Australia. You'll see more private credit, I think. You'll see more kind of private debt, different types of real assets and real return structures, as well as private equity grow over time. Why now? Private equity buyout valuations are materially below the public markets, and I think with the rise over the last year or so, particularly in the Magnificent Seven, this contrast has become more stark. Typically within our private equity book, when a company goes for an exit event, whether it be IPO or most commonly strategic sale, we typically see around a 30 to 40% uplift within our own portfolio companies when they have their exit event. which shows that the valuations are conservative. And it's something we really look for within our private equity book as investors. I think valuations is one of those topics where it's like valuing your house. Everyone has a price. Most people say if I don't get that price, I just won't sell the asset, which is kind of similar to private markets. People think their company is worth a particular value. If you get the right comparables, you can always justify your price within a range, maybe 20 or 30% either way. But until you actually run an auction and sell that property or sell that company, you don't really have a true mark, right? You have an estimate or a best estimate of what you think that asset is worth. And what we like to see within our portfolio is a very diversified portfolio with kind of a large number of GPs with uncorrelated risks and markets, and that portfolio turning over very regularly. So we like to see ideally shorter hold periods amongst our GPs so that we can have regular feedback as to how conservative or aggressive their valuations are. The more data points we have, the more we can say, hey, this GP's been around 20 years, they've exited 100 companies, and on average, they've been at 20% discounts. So we know on average their valuations are conservative. The mid-market is where we see as, or what I actually personally call what private equity should play in, or the true essence of private equity. So today, because of the secondary market and continuation vehicles, there are a lot of sponsor-to-sponsor trades, which is like one PE firm selling to another PE firm, like KKR selling to Blackstone, selling to Carlyle, and kind of these assets, while they may be good assets, kind of going around in a circle. The price kind of varies with the public markets, and the debt levels vary with the capital markets. And some investors make money, some investors lose money, but you're very much dependent on market beta. Whereas where private equity historically grew up and made a lot of its money, and where I think is where private equity really should play, is in the mid-market, but more specifically in helping founder-owned companies professionalize. And so I think where the true advantage of private equity is you take a business which is typically founder-backed, which hasn't had any institutional capital behind it before, right? And you help that company to professionalize its IT systems, so set up SAP or NetSuite or other systems and really professionalize its processes, introduce proper governance and boards, etc., and then put capital behind it to then scale that business, right? And that's where you can add a very significant return of capital. You can see on the chart on the left that mid and small buyouts typically outperform the large caps. But what this chart doesn't really show is the risk level. So I would say, as you've seen from the quartiling charts, the top end quartile, there's a big dispersion. In small and mid-market buyout, the dispersion is also larger than large cap, right? And so if you don't really know what you're doing, you're probably better off going into the larger end because the volatility is lower and you're still getting a good return relative to public markets. But where you can generate kind of real alpha is by looking at that mid-market or that smaller end. I'll kind of go run through a couple of the key sources of value creation or the typical parts of a private equity playbook. I think these are quite instructive because they also help inform why the volatility can be lower even when there's times of downturn compared to the public markets. The first one is kind of organizational effectiveness, being able to manage the business both for improved working capital. We see that quite often when PE goes into particularly family-owned businesses. They never even ask their suppliers, can we have like a 3% discount because we have X amount of scale? Just simple changes like that, but more specifically, kind of optimizing working capital, trying to enhance the systems and processes, and ensuring the CapEx is spent in the right area. So we've invested in a number of consumer companies as MLC. We're never surprised these days when we walk into kind of a successful consumer company and they don't actually know which SKUs are the profitable ones or which products are the profitable ones. They kind of sell them and go, hey, we're making a lot of money. But hey, when you break that down, we've got like 3 kind of hero products which are really taking home all the margin, and they've got like 10 other products which are significant cost centers or someone's pet project. The second point is talent and recruiting. And here really alignment of interest is key. So being able to structure a management incentive or equity plan to align the investors and the management team. And so removing some of that agency problem you have in many large corporates where the employees kind of turn up for a paycheck but aren't really motivated to help grow the company. When you give individuals equity and real potential to share in the upside of the value they create, so if they generate a 3x return, they can share in 10% of the equity that's created. But if they generate a 4 or 5% return, they can generate 15% of the, or share in 15% of the equity. Suddenly you see kind of that spark and that motivation. And a lot of the firms, particularly in the big end of town, you've seen implement this in what we call broad-based employee option schemes. So KKR has been one of the big advocates of that in recent years, but we've seen that a lot more across the industry, recognizing that benefit of having all employees participate in that upside. Expanding into different markets, being able to really drive revenue behind the right products, as well as M&A are some of the kind of other key value drivers. Here we just run through a chart of the different levers of value creation. I think private equity gets a bad name that quite often people think it's just financial engineering and it's just public markets with a bit more leverage on top, particularly in the mid-market. But overall, when we look through the data, generally leverage accounts for less than a third of the value creation for most private equity deals. Within our MLC book, it's actually kind of a negative contributor. I think that's just the time period that this data was taken over. It was in a period where companies were quite levered when we entered into the companies, and they had to de-lever over time because the equity markets and the leverage markets became more tight. I think going forward, you'll see that return to around 20-30% of value creation will be from leverage. Particularly these days, kind of leverage, especially for mid-market companies, is quite hard to come across. And so those which are able to get some leverage from day one typically are very high quality companies. Multiple expansion, while it does get a bad rap, quite often that's really a core value driver for mid-market companies, because one of the key things you can do when you buy a mid-size or small business is really scale it to the point where it can become a larger cap or larger size business that can then list or be attractive to strategic acquirers. And then when you'll be able to do that, quite often we'll see a multiple re-rating of 2 or 3 turns. And so if you think of the businesses that a KKR or Blackstone will buy, they're typically trading at 12 to 18 times EV to EBITDA, whereas most mid-market companies we'll see in our portfolio trade for high single digits, so somewhere between 8 to 10 times. The trick is how you then grow that $100 or $200 million business to be more like a $800, $900, $1 billion plus business. Finally, I'll just touch on quickly portfolio benefits and what we've seen in our book. These are the relative returns of the MLC portfolio in yellow in the private equity asset class compared to the MSCI All World. And you'll see kind of this consistent outperformance over long time periods, so 5, 7, 10, 15, 20 years plus, consistent kind of 4 to 5% outperformance of public markets. I think this is characteristic of kind of a well-run, mature program. In the short term, you will see more volatility, and there will be years where it'll underperform public markets, particularly when public markets are having very bullish years. But over the longer term, you generally will see private markets outperform. I think consistency is a function of 2 things for MLC. One, consistent investment, and the second one is diversification, both across vintage year, but also geography and different industries. I think one of the big mistakes that some kind of our peers and others in the market do when they enter into private equity, they're like, hey, this is a great asset class. It's got really kind of attractive risk return. Let's put in like $1 billion this year, right? And then next year the market comes down and their book is not looking so great. And they're like, oh, maybe we should deploy 0, right, this year. Or maybe we should even pull out of the market and sell some assets because we're overweight or overexposed. And typically what happens is you end up kind of mistiming the market and entering at the worst times and selling at the best times. And the reason is what we call like the denominator effect. When the public market book runs really hot, when the markets are typically frothy, you have more kind of nominal NAV. And so when you allocate kind of 5% of your book to private equity, it's quite a big number. And then when markets collapse, your percent in private equity looks significantly overweight, and then you're encouraged to sell. Fortunately for us, we've had very supportive boards who've understood that dynamic, and we've been very disciplined to stay kind of underinvested when the markets are bullish. So we're kind of fully invested when the markets run the other way. Finally, we can see kind of this is an example of that efficient frontier and how private equity, you're adding somewhere between 2% down the bottom up to around 6 or 7% to the top of the chart, has improved the risk-return profile. And this is actually MLC's own numbers across all our different portfolios. We've actually had the state, because of various mergers, we've had some of our books which didn't have private equity, and others running exactly the same strategies where private equity has been added. And you can see the benefits that it can produce. Generally an increase in returns of somewhere between 0.1 and 0.5% across the various time horizons, while minimizing the expected risk or loss, which I think is a great outcome for investors. Right. Thank you so much.
Thank you, David. Just any immediate questions for David? We have got a few. David, running ahead of time. We have got a few moments. If anyone's got any immediate questions.
I do. So, David, you talked about examining the companies you invest in. I mean, what level of so presumably you're using underlying GPs to source those companies. I mean, what level of transparency do you have to where the money is actually deployed?
Yeah, the transparency has increased a lot I've been with MLC, as I mentioned, 16 years. I think for buyout transactions, the transparency has always been very high. So you always get a full set of financial due diligence report, legal due diligence, commercial due diligence. These days, we typically also get ESG due diligence, and because everyone's so risk averse on cyber risk, we often get tech due diligence as well to see how strong the platforms and the technology is. The buyout side has always been quite good. As I mentioned, the level of due diligence has only increased over time. Where we've seen kind of the most marked changes is in kind of the venture capital world. So that used to be quite secretive. I remember when we first invested in some of the top tier US names, they wouldn't tell us what was in our book, which we thought was quite ridiculous because we're investors. But they were so hard to get access to, you kind of were lucky to get an allocation. And so you're like, thank you for us getting in. We'll kind of figure out what we're investing in later, but we're generating like 30% returns. So I guess while we keep doing that, everyone's happy. But about 10 years ago, with increasing regulatory scrutiny, both in the US with the Freedom of Information Act and then in Australia with public holdings disclosure, that became quite a strong push from all the investors to actually kind of have a lot more disclosure. And we suddenly saw access to data rooms, which ironically we never had when we first started investing in some of these venture funds. But over time, we've seen that kind of expand to what we would call a very transparent level of due diligence. So not only do they tell us all about their holdings now they have portfolio workbooks where they'll display all the financials of all the companies, where they exited at, how they're tracking. We'll get access to monthly budgets or quarterly budgets, and then reconciliations against that. And so these days, it's probably very equivalent to what you would see, if not better, than the public market books that we run at MLC.
Thank you again, David. We'll have him join the panel. So just last speaker for today, we have Adam Roberts, who's Head of Private Markets at Australian Ethical Investments. Adam joined Australian Ethical in June 2024, bringing 15 years of investing experience across real estate, infrastructure, private equity, impact investing, and private credit. Prior to joining Australian Ethical, Adam held several roles within Macquarie Asset Management's business, both APAC and Europe, as well as Head of Strategy, where he oversaw the business and corporate development. I think got him online. Excellent. He's up and running. Thank you, Adam.
Very good. Maybe two observations before I jump into the presentation. I think it's been at least consistent, the themes across each of the speakers. So at least if they're wrong, we're all wrong together. I've got probably similar type themes to talk about today, so I'll make sure I run through some of them pretty quickly where we've maybe laboured the point. The second point maybe I'll make is maybe it's an apology. Maybe we should have scheduled a coffee break before I jumped in because infrastructure is inherently boring. And so maybe at this stage of the afternoon, I might fall asleep on a couple of people. But
You and the discussion is what's standing between us and a drink.
exactly right. So, but I want to highlight the reasons why it's great that infrastructure is boring when you're thinking about it as part of your portfolio. So we'll jump through. Everyone's kind of had a slightly different definition so far today of what a private asset. So I might just frame it in terms of how I think about the world. We've got venture capital on one side of the spectrum through to infrastructure and property on the other side. There's probably two ways to think about it. It's the types of risks that you're taking on and the types of underlying assets or physical assets that sit around your investments. So for me, when people think about venture capital, some people think about sort of throwing money at a wall and hoping something sticks, but it largely sits around you've got a new business model, a new technology, it's unproven or it's slightly proven and you need to sort of bring it to the market. The next being growth equity is sort of taking something there that has been proven out in some way, but in order to make that business worth more money, you need to sink growth capital into the business. Those businesses are going to be loss-making and need more capital, and you need to hope that at a period in the future somebody values it at more than it is today to be able to find that extra capital. We've talked a lot about private equity, but that's going to be into more stable, traditional businesses, taking them from X to Y and hopefully taking them on a journey when there's sort of a material improvement in terms of the quality, the processes and the earnings that sit around the business. Then we get to the left-hand side when we're talking about infrastructure. So it's an asset that there's physical assets there, there's either long-term cash flows, regulation, moats around the business, because ultimately at the end of the day they're sort of essential services. So whether it's yesterday, today or tomorrow, they're a business that exists in society for a purpose and will continue to be required good times, bad times. And so this is kind of the point that we sort of, everybody's brought up this afternoon as to why, but sort of just really quickly in my words. So we've talked about more diversity. We've had some stats around the number of public companies have roughly halved. When we think about it in the US, the number of private capital-backed assets is up 7 or 8 times over that same period. So there's about 2 to 3 times the number of private equity-backed businesses in the US than there are listed companies. The opportunity point, again, has been talked about here, but as businesses stay private for longer, they've gone from being about 5 years to sort of 10 to 12 years today. You're seeing far more of their growth happen in the private universe, which means that when they do eventually come to the public markets, they're far more steady state, kind of chugging along businesses, and you've missed out on the opportunity to be supporting that business go from X to Y and see a material part of its growth. The focus points, probably the biggest one in my eyes, which comes down to having a targeted group of aligned shareholders. So when you buy into public markets, you own a fraction of a company. It's a residual claim over the business, whatever drops to the bottom line, and the board decides to issue as a dividend, or where the market sees the listed share price move. It's very different in private assets. You own collectively that business with yourself or a few other people, and what you're looking to do with that business is really aggressively drive an outcome. And so what you see in the US is that people have benchmarked the Russell versus private equity indexes, and there's about 1.5% to 2% of extra EBITDA growth that's being squeezed out of private companies, and that's largely because the shareholders are on the board, control management, control a business plan, and drive a business from X to Y, which then links into the more patience piece, which is you're not looking at quarterly reporting cycles, you're not thinking about what you're going to message to the market next time around. You're able to invest for the future and see your investment decisions through. So there's far more CapEx that gets spent in private businesses. So the board and shareholders decide to say, hey, I'm going to invest here. The payoff period might be 1 year, 3 years, 5 years, whatever it is, but we can believe and continue to make that investment rather than be at the whims of the public market, people's sentiment, the mood changes, and people aren't prepared to invest that capital anymore. So we'll come back to infrastructure. So what do we like? We talked about it. Physical assets that have an inherent worth, whether it's infrastructure, real assets, real estate, asset-backed private equity, and as I mentioned, sort of essential services that we need in the communities. And so we have sort of inflation linkage, so in periods of high inflation, periods of low inflation, the assets continue to perform. They're unique opportunities. They tend to have sort of a large moat around them because you can't tend to have too many of these businesses competing with each other. Sometimes in regulated businesses by design, you don't have any competition, and therefore that's a great steady cash flow to have. And then we'll come to the next slide as well. We also think about it from a future-focused perspective. So infrastructure is a really great place for you to think about when you're exiting this business, what does the world look like when you are trying to sell? That's how you determine what your asset's ultimately going to be worth. It's not what you paid today, it's what you're able to sell it for in the future. And you're able to really think about, well, where's the world moving to? How are people going to value these types of assets in 5 years or 10 years when you're looking to exit? And so we invest as a house across sort of 5 key thematics. You know, there's a huge need for capital over and above what's forecast on the decarbonisation side. There's a gap of about $3 trillion that's needed. On the circular economy side, there's about 2 million tonnes a year of waste that goes to landfill. 99% of the goods that are produced each year go to landfill within 6 months. So there's a huge need to solve that problem, and we're getting to the stage as a society that there needs to be a solve for it because it can't continue the way it is. So with each of these thematics, we think that there's a tailwind that we think that we're investing into. It should help us, as I said, for our exit. Digitalisation, we've talked a lot about AI, data needs, but also the importance of sort of digitalisation for education and for jobs. So 4 out of 5 jobs now need sort of digital literacy. There's a place for us to play in terms of being able to take businesses from A to B on that front. Urbanisation, changing demographics. So 1 in 10 houses in Australia have 3 or more spare bedrooms. So there's a supply issue from housing. The median family can only afford less than 40% of a family on $200,000 income can only afford sort of 40% of properties that are out there. Somebody on the median income can afford less than 10%. So there's a supply issue there as well. And then changing demographics, over 60s, over 80s, they're going to double and triple over the next few years. So you need purpose-built accommodation and health services in order to sort of satisfy that part of the market. So making long-term investment decisions today, it needs to happen today. There's a capital need, there's a time period, but then you're selling into a market in the future that's going to benefit from these tailwinds. And so I came from an institutional investing background where you'd go to a big pension fund and you'd bang your head against a table and you'd talk to them 100 times in a year and then you'd get a really big allocation out of them. They're happy to go into some very long-term, illiquid type structures where they might want to hold assets forever. They may never want to find liquidity. But when you move into the wholesale world, and we've talked about it today, what are the 3 things that are really important? So liquidity, diversification, and scale. And so when we think about how we take products to the market, we're looking to address those things first and then sort of backfill a product in order to be investable. So from a liquidity perspective, you're looking at sort of at a minimum sort of having quarterly liquidity, monthly applications, quarterly redemptions. From a scale perspective, you want to be able to bring in small licks of capital and not have sort of the large minimums that sort of typical private equity funds would have. On the liquidity point, you know, it's not a 10-year closed-end kind of fund where you take money today and someone makes a promise they'll give it back to you in 10 or 12 years' time. And all of our products are open-ended and evergreen. So the idea is that you have one capital call today. You don't need to worry about that drawdown effect over time. Then from a diversification perspective, so we're both a fund manager and a super fund, and so have access to a lot of the best partners and the best origination sources, both in Australia and globally, and we look to bring that together to create a thoughtful portfolio that sits across those thematics, across various different partners, and across different time horizons as well. So one of the things that helps with liquidity is making sure that you've got different phased investments, so you've got different money being realised at different points in time through the future. And then I think we've talked a lot about the bottom 3 today in terms of how you find the right partners, how you diligence the good from the otherwise. how you're able to move quickly. A lot of these co-investment type opportunities, you've got a relatively short period of time. You've got a comprehensive but targeted set of information. You need to be able to work through how you get from A to B to solve all your legal, your governance, your documentation, etc. And then access as well. Sometimes there's a little bit of self-selection bias, which is the things that you're able to see are the things that nobody else has wanted, because if everybody else had wanted it, there would have been a lot of competitive pressure on getting access to the opportunities. And so we'll jump into unlisted infra. And so we target it in two different ways, on the debt side as well as on the equity side. And we think about debt again, as I said, infrastructure debt in the bottom left-hand corner. It's the most boring of asset classes, but we really like that, right? The reason being the types of characteristics for infrastructure loans. They're projects that have long-term contracts, so somebody's agreed to buy the electricity or the energy that comes out of a renewables project for 10 plus years. Your loan is only for 3, 5, 7 years, so you've always got coverage on the revenue side on your business. The projects themselves, you're not buying land like you might be in real estate credit on the hope that you get your approvals and the building gets completed on time and on budget and somebody buys it at the end. Lots of the time your capital is flushed through as a result of the revenue that comes out of these businesses. The build cost is a far more larger component on these projects, and they're typically wrapped as well, which means that somebody has decided to guarantee delivery of these projects, and the amount of leverage in these assets tends to be smaller than in real estate credit. On a total development cost basis, it's sort of 40 to 60% as opposed to sometimes 80 to 85% of cost being provided by the lender. So I'm maybe running ahead of myself in terms of slides. And then why we like it from an opportunity perspective. So we're about halfway on our transition to net zero. The first half has been much cheaper than the second half, just by virtue of people deciding to do the cheaper projects first. And so there's about 50 to 60 billion remaining of capital that's needed in order to get to our net zero numbers. As I mentioned before, about half of that will be equity and half of that will be debt. So there's an enormous opportunity to finance these projects as they come online. And from a lender perspective, you're not taking any risk on whether they do come online or not. Your capital is only ever used once there's a project and a contract and a builder, all of your permits, and it's only ever drawn usually behind the equity going into these projects in order to make sure that there's alignment with the developer. As I said, sort of debt and equity. And then the other thing that's interesting just to think about when you think about infrastructure debt versus corporate credit, and obviously these little ups and downs are illustrative rather than an exact science, but when you think about what you're doing with an infrastructure asset, you're spending a lot of money up front, and you're earning a return of that capital and a return on that capital through time. So infrastructure assets have very high margins because there's not a lot of operating noise that needs to accompany them. You've spent on something that then generates you a cash flow through time. So the high operating margin means that there's a lot of cash flow to service your debt. And so you really feel really comfortable in a capital structure that this asset continues to spit off money to both pay your interest, but also amortise your outstanding loan balance, a bit like a mortgage, over a much shorter period, over a 3, 5, 7 year period. As opposed to sort of a corporate asset where you might have lower margins and there's periods of time that debt service becomes tight, and there's periods of time that there's sort of super serviceability, and these types of projects tend to sweep any of the excess cash as well to sort of be a bit more conservative. And when you think about what does a project look like, the black box at the model at the bottom is sort of the cash flow that needs to go to pay debt. It always should sit beneath the contracted cash flow, so that you always feel like there's a contract there, is guaranteed revenue coming in from a renewables project. And what you'll see is why we like to be in the debt rather than the equity is the equity is far more back-ended in these projects. And so somebody, not to say that it's not a good place to invest, but that cash flow is coming further in the future. There's far more uncertainty around that, which is why you earn a higher return on it. Whereas we really like the fact that infrastructure debt can play a role in your portfolio today where it's immediately spitting off income for you. The loans just naturally amortise over a short period of time. So you're thinking about how you get liquidity. If there's not a buyer of your position when you want to come into it, well, chances are there's a natural flush over a few years of time in order to get your capital back. And then I might be standing in the way, but correlation, you've got very low to negative correlation with other assets, which is why I think on one of the earlier slides you even saw in it, infrastructure didn't have a negative drawdown across the cycle. Obviously, there are still opportunities where there are capital losses, but what tends to happen if there are any loans that are in default, there is just so much asset backing behind them that the level of risk on impairment on infrastructure debt is very low. And moving it into a portfolio, this is a 60-40 Aussie and global fixed income, so it's not equity and debt. But when you look at how you allocate 10 or 20% infrastructure debt into your portfolio, you're increasing your expected return, you're decreasing your risk, and so we really think that there's a nice natural place for it in a portfolio. Our particular approach, so we have an Australian-focused infrastructure debt fund. We have 15 loans across all states except for Tasmania. It's performing, it's targeting about 3% over cash, and we're sort of performing, very much in line with that. There's a combination of solar, storage assets, so batteries, and onshore wind, and there's a diversification across who are the off-takers, so who's buying your electricity, who owns each of the projects, where they're located. And location's really important because the wind blows in different places, blows at different times to when the sun shines, and the grid connection's so important these days. Sorry, it's all a bit nerdy perhaps for this audience, but you want to make sure that you're in certain locations where you're getting diversification across the portfolio. And so, predominantly renewable energy, but we also see some social infrastructure. When we talk about property, it's effectively social infrastructure as well. So it's not going by building residential homes, it's potentially social and affordable housing where there's a 10, 20, 25-year contract to government, etc., where it's more akin to an infrastructure project. As I said, so performance over the last 12 months just shy of 3% over. We think on a risk-adjusted basis that's a really good outcome. With some of the assets that are in the portfolio today, that'll probably start to nudge slightly higher. And when you think about it, we talked about it earlier today, this is very much a take money that's either in term deposits and get slightly higher return, or take it out of your fixed income portfolio and move it into private credit. Just a couple of examples really quickly. So I mentioned it earlier, but we're doing solar across different locations. Something like pre-construction is very exciting for us, where you're earning you're coming into that very late stage, no capital's being drawn until it's all ready to start construction, but you're earning an undrawn fee or a line fee or an upfront on that, which is great to lock in some forward tenor and to lock in some return today. I'd say one of the interesting points is that banks are doing a lot of this, and banks are very good at lining up inside the box and saying, if this meets all of the things that we need, big project, and they need to be very big, $400-500 million, we'll do all of our work and we can lend at a very attractive rate to that. But in terms of how the grid comes together, you can't always build $500 million projects here, there and everywhere. And as the projects start to become mid-market, which has been a theme of today, and as there starts to be a little bit of a capital solution that you need to actually think through, which quite often banks aren't able to spend time problem solving for, you're able to extract an outsized return on those. And as we said, we've also got sort of a combination wind, solar for diversification, and battery storage projects as well. Batteries are really interesting because they play a very important role. There's some grid stability, so every minute or every 5 minutes there's different amounts of energy generation coming out of the mix, and so batteries can sort of touch it up a little bit and take a little bit when there's slightly too much or slightly not enough in the system. You're paid by the energy regulator for providing that service. So that's one place that a battery can work. The other is about energy arbitrage, and so you have periods of time where in the middle of the day when there's too much energy, you'll charge up your battery for free, and then at 7 o'clock at night when everyone's come home and boiling their kettles and cooking their dinner and watching television, that's when you're able to discharge into the market and earn a very high return on the marginal price at that point in time. And then we might just for a couple of minutes talk about equity as well. So that's a lot on infrastructure debt. How do we think about infrastructure equity? Well, it's across the same thematics. But what we're trying to do here is to be able to create a big, broad, diversified portfolio of assets aligned to these thematics. So as I said, again, it's an open-ended fund, monthly apps, quarterly redemptions. We're sort of 50% Australia, 50% rest of the world. More than 30 underlying investments today, so you're getting diversification across the partners that we work with, across the thematics, across the sectors, across the age and stage of each of those assets. You know, the portfolio is $500 million today, so it's big enough to get diversification and be relevant to people. And the way that we've gone about it is we've got a little bit of listed exposure, but predominantly co-investments alongside, you know, Macquarie's, Brookfield's, you know, Blackstone's, QIC's of the world. I think I've just talked about all of these points. When you sort of bring a portfolio together, so what are you trying to achieve on the infrastructure side? It was kind of neat because this number lined up with somebody's earlier today in terms of target returns, so at least we're all on the same page. But when you're looking at bringing all of that together and having that diversification with liquidity, that's kind of your target return. And what ends up happening is you've got an open-ended product, which means that you're not necessarily just buying, building or fixing and selling assets. You might want to have a slightly longer ownership period, which might amortise some of that return over a bit longer. And the liquidity plays into that again. But what you'll find, if you're able to deliver sort of, you know, 10 to 12, 11 to 13 on an infrastructure portfolio, it materially decreases risk and increases return on an overall portfolio. Some of the partners that we talked about earlier, what the portfolio looks like today, some of the stuff we've been up to in the last little while. So, well, what does infrastructure mean? So Repurpose It is a soils and organics business in Victoria. So they basically take contaminated soil out of construction projects, wash and clean it, and then you can use that soil or rock back into those projects again, rather than having to go and mine new rock and putting that contaminated product into landfill. So it has about 50% market share. It has proprietary technology, and it's competing against landfill, where there's a landfill levy in the market, which means that the government set basically a fine, if you like, or a toll on using landfill for this type of thing, which means that you've kind of got negative pressure on pricing. We've got a build to rent project. Half of that project, so about 250 apartments, are affordable, and so the government pays you a cash flow to rent them below market. So we really think about the risk return on an asset like that. We've got an aged care business, again, government-linked cash flows. Octopus is a renewables developer and also renewable software technology that is being rolled out by all of the big network operators in order to manage renewables onto their systems. We've got a data centre platform in the US. This is using 100% renewable energy, and it has a thoughtful way on its water usage as well. So it's sort of closed system water, because some of the resource intensity around data centres is sort of a big question mark into the future. Then we have a venture capital platform that's going into early stage climate focused investments. And we really like that because it's a few things. It helps inform what we're doing in the other parts of our business, because, well, how are you potentially going to get, taken out of a job with the next big thing, and how is there going to be a risk on some of these long dated infrastructure projects? But also climate tech's a really important part of getting to net zero, because there's a wedge of net zero, which at the moment is a little bit of hope in terms of how we're going to close that gap. And it's going to come from one of the next big things. We'd like to be investing into that sector, but it's very important that it's a win or lose sector, so you need to have specialists that are on the tools day in, day out, understanding sort of addressable markets and the winners overseas, and who will succeed and who will fail in that space. So I might pause there, see if there's any questions.
If there isn't, I think we're a couple of minutes ahead of time, but bring the rest. Oh, sorry, apologies.
Just on the credit side of things, I was just really interested in the lending. Is it on a floating rate? Do you do fixed rates? Like, how do you hedge with interest rates going up and down so quickly at the moment?
Yeah.
What you're going to do, and is it the duration? Do you go, okay, the project's 5 years, we're going to do 5 years? Or how do you think about that?
So there's not a perfect answer because it sort of depends on where you are in the cycle. At the moment, the way we go about it is taking a floating rate with a floor. So we're looking at the world today and saying, hey, we'd really like to lock in today's pricing, but what's the implication or how do you go about doing that? So we might say, hey, you've got base rates at a bit over 4 today. We might lock in a floor on that at 3.75 for the 5-year period, which effectively lets us underwrite that at a fixed return for today. Why does our counterparty do that? Well, there might be less options available to them, so that's just what the market is today. Or similarly, it might then be affected in terms of their drawdown through time, and so maybe you might do something funky with your line fee as well in order to sort of help them out a bit while also lock in that return for you.
Brilliant, thank you, Adam. Everyone, just thank you, Adam. Thanks, Adam, for his presentation, and we'll also bring up. You want to stay up there, Adam, for the panel discussion. We'll have Russell, David, and Kieran join us back out the front. Now, I'm hoping, I know it's 4:30 and it's been a long day, but I'm hoping for some interaction and questions from the audience. But while everyone's thinking about their thought-provoking questions, I'll a common theme that and comments that permeated all of your presentations was this importance of partnering with the right manager and the dispersion in private markets. You all spoke about how important it is, but what does a good partner look like? What are the characteristics of a good private equity, private credit manager? Because there's a lot of options coming to market. If you're an advisor, you're probably getting 5 phone calls a day from a different private credit manager that's coming and wanting to speak to you. But what does good look like?
I might take a first go at that. I think in private equity, if you hear enough pitches, everyone's mid-market these days and everyone's top quartile, so it's pretty hard not to pick a top quartile manager because everyone pitches themselves that way. At MLC, we've distilled our philosophy when selecting top quartile really to kind of 2 main ideas, which kind of bring it back quite simply is kind of where do you invest your own money, right, is the first idea. And that's kind of how much skin in the game you have. And the second idea is how you make your money. Is it how much you make from management fees, which is just sitting on the money, versus how much you actually have to generate performance, right? And effectively for those 2 components, the greater amount that they can show that they are only getting paid when they have outstanding or outsized performance, we like that. So quite often we will ask for a budget of their management company. How much can they actually make? And ensuring that they basically break even at the management company level, and they then need to actually generate returns to produce kind of strong economic outcomes for their team and themselves. And the second point is where they invest their money. So for most of our GPs, the standard GP commit or how much they invest in their funds, for the large caps and most managers is probably about half to 1 or 2%. For most of our portfolio, we like to ask 5, 10, 15%, or something that's very meaningful for the individuals involved, noting their personal circumstances. And so that's kind of how we put additional screens onto the typical screens of what is their track record, what's the pedigree of the individuals, have they worked together, what's the market opportunity and supply demand of capital.
So a couple of comments, and agree with all that. There's a lot of persistency in these industries. So the managers who've performed well historically are the managers that perform well into the future. And the reason for that being is that everybody who's looking for money wants to go with a winner. They want to go with somebody who can help them or who can execute on their deals. And there's nothing like historic historic track record to get future investors, future companies comfortable with dealing with you. The other thing I'd point out is that in these global markets, specialist expertise or sector expertise are really important. So what you'll find, it doesn't really apply in the Australian marketplace because everybody's a generalist, but the specialist managers, who might focus on software, who might focus on roll-ups, who, might focus on, whatever industry, they are the best managers because when you go and you talk to them, they know exactly what you're talking about. And so, we particularly like that. And that's actually one of the reasons why we don't like the Australian marketplace, because it doesn't have that level of expertise.
I can maybe talk about something. Sorry, I've got it mic'd up. Thank you. So I'll talk about it from a slightly different perspective, maybe giving an actual example when we've looked at specifically private equity. And it'll resonate because it's actually exactly what these guys have said. It's the same sort of things. So what we're looking at, and a manager that we're putting into our retail portfolios via a fund and then also offering out on a wholesale basis, is a manager that's been running since 2021. They're about 50 million US. Their staff invest billions into their fund. So it's a substantial investment. Their performance, they started off in public markets, went into private markets. Their performance in public markets has been 20% over 24 years. In private markets, 28%. So we think, skill, if someone has demonstrated skill in the past, they're more likely to demonstrate it in the future. If they haven't demonstrated skill in the past, they're highly unlikely to demonstrate it in the future. But then also, if we have a look at a firm like that, a deep, very, very deep sector experience, but because they have this public and private, what is quite incredible is that the sector specialists on the portfolio side are going across private and public within those sectors. And relatively innovative. You will see this in not just this manager, but there are some managers that use a crossover strategy, which we quite like. This is a bit of diversification in there. Crossover strategy means they're running in publics, and then they're also running in privates at the same time. So you might have 70% publics, 30% privates, or you might have 50-50. But they have a lot of information advantage because they've got the information advantage from the privates that they're dealing in. So we like that. It also gives us a little bit of a differentiated there when it comes to how you deal with liquidity, because obviously you've got liquidity, but then also how they structure their performance fees and things like that. They only take performance fees on realization of assets. So we like the fact that they've got skin in the game. They only charge performance fees at realization. And the way they've structured it is fair for all investors. So you don't have this illiquidity or liquidity mismatch. So what will happen is if you take your money out, you can sell down your publics, but your privates go into a separate account, and those privates are held until such time that they're realized. They drop their fees on those, and they only take the performance fee at the end. So it's things like that, but it sort of resonates with what these guys are saying, is that sector experience, how much money have they got in, what is the skill. That's just an example of one that we're actually working with right now and that we have going into portfolios.
And then maybe from our perspective, there's probably three things that we'll look for. So one is sort of institutional quality in their platform. So just the types of capital that we're entrusted to use. We can't afford to be in situations where there's a certain level of operating risk for these teams in terms of keeping key staff, in terms of how they do platform or business related workings, calling capital, managing our capital, etc. So that's like sort of a prerequisite for us. We're not in a position where we're going and backing necessarily brand new emerging managers just from the risk profile of our capital. I think the second thing that's quite important for us, it's sort of style. And so we're co-investing alongside alongside these partners. They need to have expertise, track record, that's all really important. But it's also how they go about it that's really important to us. And so we'll look at how they underwrite their opportunities, how they're thinking about delivering return, how they're going to get from A to B, and make sure that sort of aligns with how we go about investing in our business. We don't want to be misaligned with somebody as to how they're going to extract value, the underlying approach to running a business, how they think about workplace health and safety, how they think about ESG, how they think about sort of the ethics that sit across their investments. So there's sort of the other things that we'll look at. And it's hard to explain, but it comes out from going through it with them. It's very rare that we're going to make an investment it's impossible to make an investment without really interrogating all of this with the team, and that's quite time consuming. So that's why you have to be highly selective.
Fair enough. I have to do it with. It seems that the underlying theme for all of these investments is sort of interest rates to some extent. Is the major risk with the investments, whether it be PE or private credit or infrastructure, the rapid change both up and down around that and how that impacts the projects. Like, for instance, like 2022, obviously that impacted a lot of the exits in the PE space. I think from some of the renewable projects that sort of impacted the returns that could be generated. Is that the sort of risk that we're dealing with?
I'd say interest rates definitely have an impact on the overall market. Like at MLC, I also sit on the Infrastructure Investment Committee, so I see kind of all the deals that they bring across on that side of the table and how it compares to what we're seeing on the private equity side. Within private equity, basically the larger cap you go, the more interest rates play a key role into generating successful returns. In the mid-market, leverage, as I mentioned before, typically is less than a quarter of returns. And if I look at probably like the last dozen deals I've led at MLC, because of the change in the cost of capital and the increased cost for mid-market companies to raise kind of private debt and private capital, we've actually done about half those deals, or I've led about half those deals with no leverage on day one, which I probably haven't done for a decade, is bring IC to the IC deals where we didn't have leverage day one. And the logic is that if the company's growing kind of in the mid-teens, we can generate our returns through other levers. And if at some point the capital markets become more attractive, we can then add leverage to the company closer towards exit. But I would say in different asset classes, and the larger you are in terms of the deal size, the more interest rates have an impact.
Yeah, so I'd say that the major impact of interest rates on the mid-market has actually been in the ability to exit. So it's actually on the buyers. So multiples are depressed because of where rates are, cost of capital, etc., which has meant that future buyers are not willing to pay the sorts of prices that the private equity firms want. And that's why you've seen a real drying up of exits in the market. So I think as rates come down, you're going to see the exits. And I think the valuations are still there. I think somebody mentioned before, nobody's selling at the moment because, why? You don't need to sell. So I think that's put a real dampener on the market, but hopefully it's just a timing issue. In private credit, mid-market global private credit, almost every loan is a variable rate loan. So you find that the spreads usually stay the same, but will go up or down as rates change. And most investors are comfortable with that, or most investors understand that when they go into this, they're going to variable rate return. So so that works for them.
Quick question from me. Thanks for your presentation. It's very insightful. Somebody mentioned 15% allocation to private markets in the future fund. Do they have their own teams, or do they put out RFPs to managers?
Yeah, most of the large programs, I would say maybe the top 5 super funds, all run money in-house, including MLC. So basically Aussie Super, Aware, or ART, us, Future Fund, all run in-house teams of, I think, Future Fund's about 30-odd people in private equity. Aussie Super's maybe 40 to 50. Typically the smaller super funds outsource that because they don't have the scale. They might have 1 or 2 people to manage the outsourced providers, but they won't have the capability to do that in-house. And so I think the trend, if you look across the industry, is more in-house, but then also more direct. And so the role of LPs is less so much allocating to funds, but now doing direct investments alongside co-investments and then secondaries as well.
I think what they're doing as well, they've got their in-house teams, but I think they buy in research or they engage with one of the big allocators to get their research. So I think Future Fund does that, as well as having a big in-house team.
Yeah, I think a few other points to add. You've sort of seen the Aussie supers follow some of the Middle Eastern investors, the Canadians, some of the big US investors in terms of that balance between in-housing versus relying on others. And I think, especially in Australia, like someone like Aussie Super went quite aggressive to in-house. You've still got to be able to originate your opportunities as well. And so what you find, some of the Singaporeans or the Canadians, they will still lean on their partners or their GPs with fund allocations in order to create deal flow. But then they're able to invest very large checks alongside them almost as equals into opportunities they might not get access to those opportunities, without those partners, because it costs a lot to have an office here, there, overseas, in various different markets, and it's a very relationship-driven, boots on the ground type investing style.
Hello. I'm just interested to hear your thoughts on recent ASIC look-in on private markets, especially in the wealth space, and what you guys are thinking around that and how that'll impact private markets long term.
Sorry, I missed that.
The recent news around ASIC looking into private markets a little more heavily in terms of regulation.
Yeah, I'm happy to.
Yeah, go for it.
So I think it's great, right? I think there is a lot of noise in the market. There's a lot of bad actors. I don't see any of them in the room here, thankfully. But I think there are, sometimes we will see something or get a prospectus and we go, wow, how did anybody do this? How they're able to do this. So I think a cleaning up of the industry actually is a really good idea. And I think the people who come out, who do things properly will come out, shining. Hopefully ASIC, have the proper process and procedure, but I think that will happen. In the meantime, it's a very painful exercise. I mean, we've got people spending hundreds of hours answering, questions that are, way over the top. But, I guess that's the nature of the regulator.
I think we from our perspective, we 100% agree with Russ. It needs to happen. I think there's an education requirement as well for the participants with ASIC as they're going through this process. But I think it's actually good for the industry. And it needs to happen because there's a lot of opaqueness there. And when you've got consumers, especially retail consumers, and you've got illiquidity and you've got potential liquidity mismatches, those sorts of things, it can drive the wrong outcomes. And the optics when something goes wrong is bad for all of us. So you actually don't want that taking place.
Question from me, guys. Just around pricing. We're talking about managed accounts and private markets, quite often illiquid. And there's a real push that we see for people wanting monthly pricing. Very hard to monthly price something when the underlying funds or the underlying assets may only be quarterly at best. And we see a lot of movement into people pricing monthly around benchmarks, which is probably going to require some adjustment down the track. How do you sort of feel about that monthly pricing on it as a guesstimate or estimate based on benchmarks, and how do you see best practices of working around it?
Well, I'm happy to go from our perspective first, maybe. So I think, where there's a mismatch like that, we don't like that at all. So we will stay away from that. There's very few firms that can do accurately monthly pricing because just the valuations are not there. And if you're getting third parties to validate that, it doesn't happen. So I think from our perspective, if you're doing this to be fair to the investors, you need to price what can be the underlying pricing can be done at the GP level. And then you can flow that through. And if that happens to be quarterly, then it happens to be quarterly. If it's half yearly, it's half yearly. It's not necessarily convenient, but I think going the other way is actually much more risky for the clients coming in.
Can I maybe try to be a bit provocative with this group as well and see if it teases out people to agree or disagree with me? One of the points I made earlier is you're not owning like public markets, you're owning a fraction of a business. Someone might be selling today because they're settling on their mortgage on the weekend and they're a price taker, and that's the market price. The businesses that we're talking about here, the way that they're valued, the way that they're thought about, the structure, the governance, there's not a lot that can happen today to a business that makes it materially different to what it was worth yesterday or tomorrow. Now, there are obviously changes in terms of regulation could come along, you could lose a big supply contract, whatever it might be. But the way that the assets are valued is relatively uniform across the market. And somebody made a comment earlier today about you don't actually necessarily know what the market will pay until you run a process to sell it. And so the point that came up around, is it reduced volatility? Is it sort of fake reduced volatility? I think it's quite an important one to flesh out and explain to people that, like a lot of maybe the people that you manage money on behalf of, if you've run a small business, that person's not going to think their business is worth any more or yesterday as it is today. And you need to sort of be able to bring that into the process. Obviously, you can't say, we'll value a company once a year and just hold it flat for that period of time. There's a bit of noise that needs to come through, changes in interest rates, changing in borrowing costs, actual performance and whatnot. But fundamentally, in my eyes, businesses don't materially change in value day in, day out, or even month in, month out. And so there needs to be the right balance when you're bringing it as part of portfolios.
Yeah, so I'd say private credit, it's not an issue. They're yielding assets and you just, accumulating the yield. So I think that's a bit of a non-issue in private credit. Private equity, it's absolutely an issue. I mentioned in my presentation about the advantages of a listed vehicle. I think the only way you can really fairly do this is in a listed vehicle where somehow, and it might be right or wrong, that there's a supply-demand mechanic in there and a price is found. And, whether that's reflective of the underlying or not, who knows? You're able to accurately price it on that basis through the quarter. And then obviously valuations come through and you see a new NAV, etc. But that's actually okay from a regulatory perspective. All types of pseudo pricing that you're putting on it in the interim, I just don't know how people get comfortable with that sort of stuff.
I would make one extra point there, and I don't disagree necessarily, but maybe it's just a different way of looking. I think as you said, private credit, that's one thing. I think infrastructure is another. PE is an issue because if we look at 22 and we had the question about interest rates, if you were at that point in time, you had those interest rates going up and you were in certain types of PE, more than the growth side, sometimes the larger cap side, those needed to be marked down. There were no IPOs, there were no exits. They had to be marked down. If you went and you had a sophisticated investor, they can arbitrage that if you haven't marked those down. So I think there is a risk in certain markets that you have to be really careful about how you value these. And if you look at some of the really good PE funds overseas, they are extremely good at valuing. They have very, very large teams there that do the valuations, and some of them actually do it on a monthly basis. And that's what we would prefer to do, is to reflect that rather than say there's a general there and they won't change price. I think because they do, under certain markets, change price. And when that happens, you can get an arbitrage.
I've got a question about private credit. When I was a much younger man, I ran National Australia Bank's hire purchase business in New Zealand because the RBNZ didn't like the bank lending HP money. And so we had a different business, which the bank owned. Well, the thing which has always interested me about the discussions about private credit is why are the JP Morgans and the Chases and the Bank of Americas not heavily involved in this, but not through the bank arm? Why have we seen new lenders emerge, given I would have thought the corporate relationships which mainstream banks would have had? It's not, so it's a question of interest rather than directly relevant to the PC market.
Yeah, different.
Yes. So there's two types of, from a regulatory perspective, two types of banks in the US. There's those major banks, and then there are literally a few thousand small banks. We kind of find that weird in this market where we've got half a dozen banks, right? Or I don't know, 8 or 9 banks in total, right? But there are literally thousands of them. And every week, a couple of banks go bust. The regulator is extremely concerned about a contagion from those small banks, and it's happened. There's in the history of the US, like there was the savings and loans debacle where a whole bunch of these things went over. You saw when SVB went over, another couple of banks fell over as well. It's a terrifying thing for the regulator. So the regulators actually, I forget what they call the two segments, but there's the big ones, and there's only a handful of them, and then there's thousands of others. The big ones actually have a lot of ability to do more lending, and then the thousands of others, that's where they've really crunched them and said, we want you to get out of this market. But there's only so much the big banks can do. There's capital efficiency that they want to deal with, etc. They'll focus on the big ticket stuff, and actually what they like to do from a capital efficiency perspective is go out and do a really big loan and syndicate that loan out. That's the business they love that business. Make a turn on their capital and put their money to work again. So this whole mid-market lending thing, which used to be the domain of these smaller, medium-sized banks, that's the part of the market that's disappeared. And I think private credit has been so good at seizing the opportunity that they've captured it. And there's no banking segment that's really able to compete with that. It's an interesting dynamic.
It comes down to the regulatory capital that they need as well. So there is some places that they will be far more competitive than any private credit source. It's within the box. They have their credit models. They go, bang, that's what I lend into. But it's really interesting. The Goldmans, the JP Morgans, they'll all have private credit divisions within their asset manager. So it's not using the bank's capital, it's using third-party capital, and then they're using their broader network and relationships that comes from the banking side in order to find those opportunities as well.
Just bring it back to the implementation just quickly. Kieran, you spoke about within your business creating appropriate liquidity to get private assets into your MDA structure. Is that a daily, monthly? How have you? I guess what level of liquidity have you provided? And I guess because there's a lot of businesses and obviously platforms are coming to the party around now being able to tolerate monthly liquid type structures. Whether you should or shouldn't put those in those structures is another question. But what have you done in your business, and what level of liquidity have you required?
So I think the first thing to make is to make a point, though, that it's only our clients going into these, and 95% of our clients are under discretion. So that is a very privileged position to be in, that type of control. So when we put them in, typically, if we look at our alts programs, both defensive and growth, they're monthly liquidity. And we've been able to work with a number of the superannuation trustees to give them comfort that they can meet their regulatory hurdles of death benefits, all of those sorts of things. They can make it. We can definitely pay that out within the fund. There are some questions around how long would it take to liquidate the whole fund. And typically, you need to get them comfort on that as well. When we look at some of the private equity stuff, so we've got a little bit in there at the moment in global. So we put in global PE, global equity, and in Aussie equity as well. What we're doing there is we have a fund structure that would have like a growth fund, number of fund managers, so it's more satellite. And we would limit that to like 10 or 15% of that fund. So if that fund has got 500 million in, we would do 50 million in NPE, because we know the liquidity is then run outside of that. So that's the way we do it, which is a really simple way of doing it. Much more difficult though. You'll have to put a lot more in place if you're going to go to the general market with that, because you can get those horrible skews when people move out very, very quickly, and you go from 10% illiquid to 50, 60, 70% liquid like we had in the GFC. And then, so you'd have to gate that very carefully.
And our products are at the opposite end of the spectrum to Kieran, where we've got outside investors in them. We need to very carefully, depending on which product it is, whether it's our listed product, our SMA product, our unit trust product, got to very carefully design what sits in the product in order to make sure that we've got the right levels of liquidity. So we actually agonize over that. And all private credit solutions or funds are not the same. So if you want to have, for instance, more liquidity in a vehicle, then you want to invest in, some direct managers who might have underlying, monthly liquidity, and there's a bunch of them that do, but you won't be able to invest in managers who have got lockups who might generate much higher returns. So there's this trade-off between risk and return, or longevity and return, and you have to, as I say, specifically design every product to make sure you don't disappoint your investors.
At MLC, we have a range of products, and I think when you're looking at private equity and talking about liquidity, there's kind of really two approaches. So we have, for example, closed-end 10-year lockup vehicles where we kind of promise 15 to 20% returns. and then we ask kind of those allocating to it to make sure it's kind of your last source of liquidity. So allocate 5 to 10% of your portfolio, but liquidate everything else first if there's a downturn, and this is the kind of asset that you try to hold forever or until the end of the vehicle. The other approach is we do have quarterly redemption vehicles as well, which are evergreen vehicles. And the way we structured that to ensure that there's always liquidity there, even though, like many of our peers, there's a 5% cap on the quarterly redemption, we've actually structured it so MLC as an institution has a kind of significant seed investment into that product, and they will effectively provide backstop liquidity to all the retail investors. So even if all the retail investors try to redeem in that vehicle, we could actually allow them to all redeem, which is quite unusual. But it is something you have to be mindful of, is even though a lot of these vehicles say there's monthly or quarterly liquidity, is that liquidity there when you need it, which is when there's a downturn and everyone wants to redeem at the same time.
And just to clarify, that's monthly redemption for that structure. So, look, yeah, I think summing up all this, and I'm appreciating we're at time, unless there's any final questions from the floor, we're between you guys and drinks. But look, I think to sum this up, obviously we've heard perspectives from a vast range of experts talking about different asset classes. I think the onus is on everyone in this room and is doing your due diligence, educating yourself on these asset classes before jumping into any of these solutions, really understanding who are the clients that you're allocating to or for, because whether they make sense to sit inside of a managed account structure or outside, we really need to be mindful of the liquidity profile of these different investments. But if everyone can just thank me we've got Kieran Canavan from Centric, Findex Apologies, David Chan, MLC, Russell Pillinger from Pengana, and Adam Rowitz from Australian Ethical. Thank you, gentlemen.
Thank you.